Understand liquidity or be the liquidity. If you don't understand what liquidity is or how it works in a market, you're going to lose a lot more trades than you need to. But if you do understand it, you can capitalize upon the areas where other traders are being stopped out, use them for your entries, and get some really profitable trades. So in this video, I'm going to introduce you to the most simple form of liquidity, equal highs and equal lows. I'll show you what it is, why it happens, why it's something that will consistently happen for the long term, and how you can take advantage of it to make more money from your trades. What you're looking at here are equal highs and equal lows. This is what they look like in real markets. Now, if you trade or have ever traded with support and resistance, you'll see that these are very similar, or they basically are support and resistance levels. Equal highs are a collection of equal highs in a market, such as what you would see at a resistance level. And equal lows are the opposite, where the market has retested a level multiple times at the same level, at the same price. This is seen as a support floor. But there is a difference in how these are traded. See, support and resistance traders will be looking to buy retests of a support floor. So when the market makes an equal low, they are trying to buy. Resistance traders are then looking to sell a retest of an equal high. So up here, if the market has formed this high, when it forms the second high or the third, they will be looking to sell that retest. But this doesn't always work, and that is because of a concept called liquidity. So liquidity in its simplest form refers to orders in a market. Orders are simply buying and selling orders. Now, when we see a collection of equal highs, like these highs here, we know that there are going to be sellers selling at each of these levels. Okay, we have resistance sellers who are going to be selling anything past the second retest. So if we have 3 or 4 equal highs, traders will be looking to sell that. That means that in this area, we have lots of selling taking place. And above this, above those equal highs, we will have a lot of stop loss orders. Now think about what a stop loss order is. A stop loss is an order to get out of a trade, which means if you're selling, a stop loss is a buy order. So there's actually a lot of buy orders in this area. Now the reason for that is, and the theory behind that is, if you are selling resistance, your stop loss is a buy trade to buy back the contracts that you've sold at a loss. So you buy them higher up for a higher price, you're going to lose money. Now equal lows works in exactly the same way. These are sell orders. There are a lot of sell orders in the form of stop losses beneath this level. Because we have buyers here, if the trade goes bad and moves lower, they will have to sell their positions and sell their contracts for a loss, which means they will take a loss, of course. Now, as well as these buying and selling orders being in the formation of stop losses, we have buy stops and sell stops. So above here, we will have buy stop orders. A buy stop is an order that triggers you into a long position once the market breaks through a specific level. So for the buyers with buy stops here, when the market breaks above these equal highs, they will be triggered into a buy, looking for a break retest style trade. So they will be looking to see the market continue higher. That means there's even more liquidity up in the highs. The same goes for the equal lows. There are sell stops down here. So there are traders on this side who are looking to take a break retest trade the other way. So when the market breaks, they will be triggered into a short, expecting the market to continue moving down. So we know there is a massive amount of orders beneath and a massive amount of orders above equal lows and equal highs. But here's the thing, markets react to orders. So basically, the only reason markets move is because there is a number of buying or selling going on. Obviously, at a resistance, there is selling taking place. That is why the market gets these smaller movements down. At a support, there is buying taking place, which is why we get these smaller movements up. But there's a more significant number of orders situated above and below these levels, because there is the selling in the form of stop losses, and there is also the sell stops and buy stops to trigger people in to breakout trades. Now, inside of the range, so inside of this area here, there isn't going to be a huge amount of buying or selling taking place, because it's simply not an optimal point to get into a trade. If you're looking to buy through this range, you're not really going to buy in the middle here, because your targets are not going to be great. Instead, you'd be looking to buy at the lows. And even more than that, the stop losses and the sell stop orders create an even larger number of orders situated underneath those equal lows. The same goes with the equal highs. So there's a significant number of orders at the top and the bottom of these ranges. And these are where people are looking to take their positions or take their losses if the trade goes against them. Now, because markets react to orders, they are going to be drawn to the points where the significant number of orders are. Let's say this market is now moving to the upside. It's going to be reasonably slow and choppy because there's not a whole lot of buying and selling and transacting taking place within this range. But when we reach this area up here, where the stop losses or buy orders and the buy stop orders are, there's a whole lot of liquidity freed up here. Because whereas traders would have been entering at different intervals from this resistance level, they all now get forced out at exactly the same time. And because markets react to orders, these areas become a very prime point for trades to either reverse very quickly or continue very quickly. That means that a lot of the time when the liquidity is swept, when the equal highs are swept, we are going to see a significant reversal from that area. And this is what is known as a stop hunt. You might have heard that term before. If not, don't worry. So people call this a stop hunt because once the market has triggered the stop losses of sellers, we then get the significant selling move taking place. Now, it's not really a stop hunt. There aren't institutional traders looking to take you out of your positions for the fun of it. That's just not how the markets work. But because there is such a significant number of orders in these areas, these are likely points for the market to be drawn to and react from. So once the market does come above these equal highs, it's this area here where the market is likely to make its significant movements. So although it's not really a stop hunt, they're not doing it for the thrill of stopping you out, it does work that way because your stop gets hunted and then the trade moves the other way due to that massive influx of liquidity. And you guessed it, we can see the very same thing happen with equal lows, which means once equal lows have been swept and all of these orders are activated, this point here becomes the prime place for reversals to occur. So we could see a significant movement in the opposite direction. That is how equal highs and equal lows work, but they're not always going to look that picture perfect in the real market. So now let's go over to a real chart and I'll show you what this can look like in a real scenario. Based on what we've discussed so far, here's a portion of equal lows in a market. So we have this low here and this low here, which are pretty much directly equal. This forms our equal low liquidity. Now, if we were then looking for a buying opportunity in this market, we would not want to buy above these equal lows. So for a support trader, they would be looking for buys from this level, expecting that because the market has reacted here twice before, it will react here again. But as liquidity traders with an understanding of this equal low and equal high liquidity, we know there is going to be a significant number of orders beneath this level. This is where the sell stops and the stop losses for buy traders are going to be situated. And because there is such a significant number of orders beneath this point, whereas what did we discuss previously, there will be less orders within the range, we can expect that the market is likely to sweep this level before any meaningful movement is to take place. So what we would be looking for would be for this equal low level to be swept out. Meaning the first thing that we need to be aware of is that we should not be buying above equal lows, okay? Do not buy above equal lows, do not sell below equal highs. Instead, wait for those levels to be swept. So now, if we play the market through, you will see that we get that sweep of liquidity. Now, there are many ways to actually trade from this sweep of liquidity. For me, I am a fairly conservative trader, and I want to wait for a significant structure to agree with me before I start making decisions. So what I would be looking for is for this previous high that formed to be taken out. We'd be looking at this high, this high. That is where we would want to see the market trade above to provide us with a trading opportunity. Because remember, until we shift structure the other way, we are currently bearish, okay? This market is coming down, forming these lower lows, and now a lower low once again. If the market doesn't break previous structure, we could easily just form a lower high and continue selling. So if we consider the current trend, the relevant trend from this high, we have structure that looks like this. And if we buy anywhere beneath this point, this one here, we are taking an aggressive trade. So in order to be safe about the position, I prefer to wait for structure to agree with me, which will allow me to lead into a larger trade. Now, I'm not saying there isn't opportunity for you to get in somewhere down here, but that is not what I'm going to be teaching you today, because I want you to be a consistent trader with a solid plan who's not gambling into these positions. So now that we've seen the equal low swept, we just wait for a break of structure. And if we get that shift in the structure like this, that will form the agreement that we want to see to then go long. And then we can introduce some other concepts. Now that this high is broken with this candle, the final candle, we've had our break of structure. Now, an important note, the break of structure only occurred with this last candle. We do not want to be viewing wicks like this as closures or reversals because this is a rejection in price. Wicks indicate rejected prices, which means at this point, we hadn't managed to close above the high, we hadn't formed the break of structure. But with this next candle that's pushed up, this has now formed the break that we want to see. So from this point onwards, we can start to use other concepts like structure and supply and demand to identify our setups. First of all, we saw a sweep of the equal low liquidity. That was this movement here, which led us into a reversal and a push to the upside. Now you can see on this candle, we had a huge influx of buying taking place beneath this level. As soon as we sold off, we had an indecision candle, which is this candle here, followed by a very bullish candle, which engulfed the previous candle and also showed a significant reversal in the market momentum. Sellers were in control, then buyers took over. And then yes, we had a slow push away, but now we've had a significant push and a break of structure. So from this point, for my entries, I like to use supply and demand. If you don't know what supply and demand is, it's simply using areas where buying came in before to buy once again. So a supply or demand zone is drawn on the last candle before the impulse. For me, that's how I trade it. And when the market pulls back to that level, that's where I want to buy from. So here we can see this large rally upwards, this break of structure. This came from this indecision candle, this last candle before the impulse. So this would be my demand zone. And when the market returns to this level, I would want to have a buy limit order placed on there. Now, a buy limit is an order that triggers you into a buy as soon as it's met. So just on that demand, I would have a buy limit. For your stop loss, you could put the stop loss beneath the previous low, and then targets you can move up to wherever you are looking to target in the larger trend. For this position, because we're now seeing a reversal, we may be able to take this up towards some previous areas of supply. So we'll look at this area, this last candle before the impulse down, for our trade target. Now, something that is interesting is you can actually use equal highs and equal lows as opportunities to take profits. So really in this trending structure, we don't have any equal highs, but let's say these highs were equal highs. We could use that as a pretty clear target for our trades because we would anticipate that any other form of equal high or equal low liquidity in the market is going to be swept. So at this point, we had our sweep of equal lows. The market traded into this area of significant orders, and we saw buying momentum kick in and push the market the other way, forming a break of structure. From here, we can now enter on demand with our stop loss beneath the low, and if you're a super conservative trader, you can clear the full previous low as well, which is still going to give you good risk reward, and then we can take our position, using a buy limit and then using targets upwards into other areas of supply or other areas of equal high liquidity. So now, allowing the trade to run out, you see that we get tapped into the position when the market returns to that demand zone, and then we have a nice rally away, leading us in to that overall target. And that is a 4% position. If you went for the more aggressive style, you could have got up to 8.9% out of this single trade. So that's it. That is equal high and equal low liquidity. The most simple and common and easy to trade format of liquidity that you'll see in the market everywhere now that you know it exists. So instead of being stopped out, you can capitalize upon these areas and take some really profitable trades with more clarity around what you're doing as well. Now, if you want to learn more about some more intricate forms of liquidity, watch this video next. And also check out the link in the description at the top. That's going to take you to a free course about building trading systems, which I think can be incredibly valuable for you. So that's it for today. Thank you for watching, and I'll see you in the next video.